The reason why I wanted to make this video is to kind of share my own experience on Robinhood and talk about some of the things that I've learned when investing and some of the common pitfalls that I see people making when they're first getting into investing. First mistake that I saw a lot of people making was over diversifying their portfolio. And what I mean by this is that people were buying 10 stocks and buying a small amount of those 10 stocks and then, just keep buying more and more and more stocks. So they would have Amazon, Apple, Twitter, Snapchat, Facebook, and like all these Tesla, all these stocks, and they would only have small portions of each company. And so what happened with this is that when each company went up, you weren't really realizing the gains by the percentage of that company going up because you were so diversified. So if you had $100 and you had to diversify through 5 companies and you had $20 in each company, then say one company goes up 100%, but the other company goes up 20%, then you make $40 in the 100% return, and then you make maybe like 1/5 of 20 in the other company. So what I'm trying to say by this is that if you would have put that $100 into the first company that multiplied by 100%, then you would have made $200. But because you diversified, maybe you only made like $130, so to speak. So that was the first mistake that I saw a lot of people making, over diversifying themselves. And we always see on social media that they say that you should diversify your portfolio. What I think people mean by this is that you should diversify in different classes of assets, meaning you should have real estate, you should have collectibles, you should have maybe some stocks, and other forms of investing opportunities like a business. So those are already 4 different incomes. But I think a lot of people are under the misconception that by diversifying they mean have your money in a lot of different stocks. So it's not about having your money in different stocks, but more so about having your money in different assets or class assets like cryptocurrency, stocks, real estate, a business, collectibles. That's already 5. So that's the first common pitfall. Like, don't over diversify yourself. Try to keep it to a minimal of how many stocks you're in, and that's how I think, in my own opinion, that you're gonna get the greatest return on your investment. The second mistake was trying to make quick money. A lot of my friends were so caught up in trying to make quick money and focusing on buying all these recovery stocks or buying call options or buying put options. And a lot of this is a big distraction from investing into a company that can potentially 10x, 20x, 30x your money. And these things aren't as usual, or they don't happen very often. But sometimes when we're trying to make quick money, we just get so distracted by trying to make quick money, like investing in penny stocks or investing in recovery stocks that were previously $50 but now they're $10. And because you're so focused on those stocks that are just gonna recover, you miss out on those opportunities to make 10x, 20x, 30x your money. So the tip number 2 is don't try to focus on making quick money, because I was focused on making quick money in the beginning, and because I was so focused on making quick money, I was missing out on the opportunities to make a lot of money over the same amount of time. So like for 3 months I was trying to make quick money and I was making maybe like $1,000. But then once I went all into Tesla and I just held my position and kept adding money to that position, I've gained over $30,000 in the whole year. So that was the tip number 2. Don't try to make quick money. Focus on trying to find a good stock and focus on finding a growth stock. All right, so the third thing that I realized was how to dollar cost average. And basically what this means is that you continue to buy the stock as the price stock goes up. And what I started to realize is that, and if I have 100 shares of a company, every $1 that company moves up, I'm making $100. So what this means is that if I have 100 shares of Tesla and Tesla moves up $100, then I just made $10,000. Do you get it? So it doesn't really matter at what price you get in, but it matters how many shares you have. And basically based on how many shares you have, that's gonna determine how much money you make for every $1 that it goes up or every $1 that it goes down. Now, this can be kind of tricky because the faster you make money, the faster you can also lose money. So it's kind of risky, but that's why you need to do your due diligence. And that's why it's not so easy, and that's why it's not easy money. But this is like a better way of looking at it than trying to get in at the cheapest price. If you're so focused on trying to get in at the cheapest price, you're gonna keep waiting for it to go down. And then what happens if the stock doesn't go down? Then you're gonna be forced to pay a higher price if you wanna get into that company. So just focus on dollar cost averaging, just buy whenever, and just focus on how many shares you have, and then focus on how much money that's gonna return to you for every $1 that the company moves up. So that was tip number 3. Number 4, the fourth tip that I have for you guys is understanding how taxes taxes work for stocks. This is one of the biggest things that a lot of people don't know about, and I think a lot of people just like oversee this step, and I think that's a common mistake within beginners. And the reason why I say this is because if you're day trading or if you're trading stocks within a year, you're gonna be paying capital gains tax on all of your earnings. So say I made $30,000 this year and I were to sell my stocks. If I were to sell my stocks today, I haven't completed 1 year yet, right? And I sold my stocks today with a $30,000 profit. And that means that I would have to pay about 30 to 40% capital gains tax on that $30,000 profit. So that would be almost 50% of the $30,000. So I would probably be left with maybe $17,000. I didn't do the math, but I'm just kind of guessing. So out of $30,000, I would only keep $17,000 versus if I were to hold those stocks for over 1 year, I would only pay 15 to 20% tax. And the reason why I say 15 to 20 is because they charge you a 15% tax for those gains, long-term gains, and then they charge you another, like in my state, they charge you another 5% for federal and state tax. So in total, I would probably pay 20% tax on that $30,000. So that would be $6,000 in taxes versus $16,000 in taxes. So just by holding it longer, not 16, maybe less than that, 13,000. So right away, you can see that by holding it longer, I'm already making so much more money just by waiting 1 year. So I think that's a very common mistake that a lot of people don't take into account. And not only will you have to pay capital gains tax on that 40,000, not only will you have to pay that 40% capital gains tax for selling your stock within 1 year, but that will also bring your salary income higher into a higher bracket. So if I'm making $100,000 today in this year, and then I sell $30,000 of stock, then essentially I have $130,000 to be taxed at that tax bracket, $130,000. So that's a common thing that a common mistake that a lot of people don't know about, and they're just trading and seeing all this money. But at the end of the year, you're gonna have a big tax bill. You're gonna have to pay a lot of money. And I don't think a lot of people care about this, but I think once they start to see how much money you have to pay at the end of the year, then you will start caring about it. So be aware of how taxes work for stocks. I'm not a financial advisor. I'm not a tax expert. I'm a beginner. I'm just some dude on the internet giving you guys some advice. And this is just some of the things that I've researched and some of the things that I've seen. And yeah, that was pretty much it. So remember, don't over diversify your stock portfolio. Try to keep your stock all in like 1 or 2 stocks, 3 stocks at most, and really try to do research on those companies. Focus on those companies. If you have 10 companies, you're not gonna do research on all 10 companies and you're just gambling and guessing. So try to keep it to 3 and try to minimize how much you diversify. Number 2, stop trying to make quick money. Pay less taxes and let that grow. Number 3, learn how to dollar cost average, meaning just keep buying shares, and for every 1 share you have, that's going to determine how much money you make every dollar that the stock moves up. And number 4, understand the taxes. Go research on taxes and how it will affect you. And that was pretty much all for me. If you did find this video useful, or you got something out of this video, please remember to hit the like button, leave a comment. It really does help out the channel, and it really helps out me staying motivated to create these videos. Anyways, I will catch you guys on the next one. Peace.